discussion of business entities can be found in Chapter 3 of the Farm Transition Workbook. The presentation will cover tax and legal issues of the various entity types. One thing to note, be sure to get competent legal and tax advice when you begin the process of creating any of the entities we're going to discuss. Here's a guide to the abbreviations that are used in the slides. Sole proprietorship, general partnership, limited partnership, subchapter C corporation or C corp, subchapter S corporation or S corp, limited liability company or LLC as we most commonly hear it referred to. We're going to look at the tax and income issues that are involved with each of these entities. On the taxation side, where's income and expenses go to? Well, sole proprietorship, everything flows through to the owner. A general partnership, also a limited partnership, we need to look at the partnership agreement. It will determine who gets what in terms of both income and expense items. A C corporation, it's its own taxable entity. So everything stays in the C corp. Any distributions out of the C corp to the individuals, shareholders, are then taxable to them. So dividends, etc., that go to the shareholders are taxed at the shareholder level. The income and expenses are taxed at the corporate level, hence the term double taxation. S corporations, it's a pass-through entity, so everything passes through to the shareholders. Limited liability companies, LLCs, the taxation then depends upon the tax filing election. If it's elected to be a single member LLC, then it's, from tax purposes, that's a disregarded entity. Works just like a sole proprietorship. Everything goes to the owner or that single member. Partnership, when it's elected to be that, it's taxed essentially or exactly the same as a general or limited partnership. S corporations, everything flows out to the LLC shareholders. And a C corporation, same thing, taxed at the C corporation level, and then when anything flows through, it gets taxed at the member level. So LLC set up as a C corp, taxed as a C corp, gets the same issue of double taxation as a simple C corp. So the allocation of income all goes to the owner in a sole proprietorship. General partnership, limited partnership, you've got to look at the partnership agreement that allows flexibility as to what gets taxed to the various partners. It allows some flexibility. Corporation, again, it all stays at the corporation level, so no allocation. They get some dividends that flow out. Corporation gets to count that as an expense. Any salaries that flow out, same thing. S corporation, remember, it's not taxed as its own entity. Everything flows out to the shareholders. The shareholders look at it based upon ownership shares on a per share per day rule. So as shareholders move in and out during times of the year, they will get their share based upon ownership and ownership period. LLCs, well, a tax filing election, like we talked about earlier, a disregarded entity, a partnership, S Corp, C Corp. We'll look then at how the tax and allocation of income does apply. So income allocation for partnerships. Well, it may not be proportional to ownership. So you have some flexibility. Some owners may not get, if you had two partners at 50% ownership, they may not get 50% of all the income. It may be allocated a little differently. The only thing that required there is that the fact that the allocation must be outlined in the partnership agreement. A couple ways of looking at this disproportional allocation would be time commitment by the partners, the contribution levels, management, etc. The allocation can be done by type of income. The ordinary income can be allocated to the incoming generation. Capital gain type income to the founding generation or the outgoing generation. It can be deferred. In other words, there are certain times that we may say, well, we don't want paid for our efforts until a few years after the entity has been formed, things have been going. So it allows some additional alternatives. We can also change this over time. So the allocation by type can change as the entity grows, as it matures, etc. Now, corporations. We're going to look both at S Corps and C Corps here. For a C corporation, all the income taxed at the corporate level. Now, distributions, those have to occur in proportion to share ownership. It also has to conform to types of shares. So if you've got people with preferred stock and people with common stock, you can have disproportion between preferred and common, but all common shareholders will be treated the same or equally based upon a per share ownership. The same thing with the preferred stockholders. So there's no discrimination allowed when classes of stock are the same for the shareholders, but if classes of stock, for example, the parents holding preferred stock, the kids holding common stock, there can be some disproportions there. Now with an S corporation, remember, taxable income flows through to the shareholders. Distributions in proportion to share ownership. Now, one thing different between an S Corp and a C Corp, with an S Corporation, there is only one class of stock allowed, only common stock. There is no such thing as preferred stock in an S Corp. So distributions, we look at share ownership. There is pretty much everybody's treated equally based upon number of shares owned. Income allocation for LLCs. Well, what we've got to look at is the tax election made when the LLC was created. If we elect to be a C Corp, again, it's going to be taxed at the entity level. If it's an S Corp, the income and expense items flow to the individual membership owners. Partnership, same thing. It flows to the members. A disregarded entity, that's a single member LLC. Everything flows to that individual owning the entity. Now, one thing to look at and keep in mind is when we develop the LLC and we put together the operating agreement can provide significant flexibility for those allocations among the different members. So, when we start looking at this, it becomes very important that we talk to our accountant, also work with our attorney, tell them what we want, and make sure the operating agreement then provides the allocations to those members as they are to be designed and desired. Now, guaranteed payments. These work a little bit like salary. However, they're not treated as salary. These payments are made no matter what level of income does occur. It's not always allowed in all the entities. Sole proprietor, guaranteed payments cannot occur. In a general partnership, limited partnership, an LLC taxed as a partnership, we can have guaranteed payments. Now remember what these are. Basically, they work like salary. They are payments made to those specific individuals or members, partners, based upon either the membership agreement, operating agreement, partnership agreement. It does not work for C Corps or S Corps. No guaranteed payments with corporations or sole proprietorships. Now, salary. Well, sole proprietorship, everything flows to the individual. There's no salary being paid. In a general partnership, limited partnerships, salaries can be paid. Under a C Corp, S Corporation, salaries must be paid to those in management. If not, they become suspect from IRS rules. They will probably be examined. IRS looks at S Corporation, C Corporation information to determine whether or not a salary is being paid, and it should be a reasonable salary. Now, the problem with saying reasonable, there is no IRS guideline concerning what is considered reasonable. It's very much of an arbitrary amount, but it should be about what your value to the business would be on the farm if you did the same type of work off the farm. Again, that is kind of what we look at for reasonable salary, but again, it's not defined. Under an LLC, if it's taxed as a single member LLC, disregarded entity, no salary. Under the others, yes, it can be in place. So salary can be treated to an LLC if it's anything but a single member LLC. Other distributions. You've got to look at what's going on from other items being paid out. Sole proprietorship doesn't matter. When we talk about distributions of anything other than income, those distributions do not have to be equal among all the partners in a general partnership or a limited partnership. For a C corporation, S corporation, anything we distribute out of the corporation has to be or is based upon shares owned at that point in time. Under a limited liability company, other distributions are allowed to be taxed as a partnership if we're allowing the business to be taxed as a partnership. Otherwise, it comes back to if it's a C Corp or S Corp taxation in an LLC. Other distributions, we follow basically the same idea of that ownership shares or ownership interest. Fringe benefits. The most common one we think of here is health insurance. Sometimes our fringe benefits can also be contributions into retirement plans. Fringe benefits for sole proprietorship, most are non-deductible, so when we think about it, yes, some of them may be. You've really got to look at what we're talking about. Some of our retirement plans, IRAs, we can get a partial deduction. Others, we may not get any deduction. You've really got to look at what we're dealing with. So sole proprietorship, fringe benefits, be sure to talk to your accountant to determine what types and what levels contribution to a health plan, etc., will be allowed as a deduction. General partnership, limited partnership, same way. Since the things are being handled by the partnership, paid then or in the benefit of the various partners, again, not going to be deductible. A C corporation, we set these things up because we want deductibility of health insurance plans, retirement plans, etc. For the C corporation, it's paying these, so they're going to be deductible at the C corp level. So they have a definite reason for setting up a C corp, but if it's just for fringe benefit purposes, it may not be all that beneficial. You've really got to look at this over with your accountant and your attorney. S corporation, just like all the others, most are not going to be deductible. Limited liability companies, basically if you start going across, disregarded entity, single member LLCs, partnerships, S corporations, those fringe benefits are not going to be deductible. If it's treated or taxed as a C corp, most will be deductible. Next, I'm going to turn it over to Shannon Farrell, who will now talk about the formation, operation, and control of the LLC or other business entity.
JC just did a good job covering many of the tax aspects of having a business entity as part of your transition plan, but there are other elements that we also need to address, and a lot of those can kind of be grouped into a issues discussion of formation and governance. In other words, how do we go about actually creating the operating entity, and how do we go about managing it from both a day-to-day perspective and from a long-term perspective as well. When we talk about who can own a business entity, with the sole proprietorship, again, it's very straightforward. Only one individual is really involved. With a general partnership, you have to have, obviously, two at least partners to have a partnership, but you can have more partners. There are many partnerships that have, dozens, in some cases even hundreds of general partners, but you got to have at least two for it to be a partnership. When we're talking about a limited partnership, we have to have at least one general partner. There can be multiple general partners, but we have to have at least one, and we also have to have at least one limited partner. Again, we can have multiple general partners, multiple limited partners at the same time, but we have to have at least one of each for us to form a limited partnership. With a C or an S corporation, you can have single shareholder corporations for both C and S corporations. And for an LLC, you can also have single member or you can have multi-member LLCs as well. There's really no limit to the number of people that we can have involved with a corporation or an LLC. I would just note that in Oklahoma and a handful of other states, about 8, there are restrictions about whether or not a corporation or an LLC can own agricultural land if it's got more than a given number of members. So that's just something to check out for whatever jurisdiction you're with. When we're talking about the formation of the entity, things are pretty simple for the sole proprietorship again as well, because you're the only person involved. So it's just you agreeing to do business with yourself. The general partnership and the limited partnership, you have to have a partnership agreement. And technically with a general partnership, that doesn't have to be written, but it's strongly encouraged that it is, for many of the reasons that JC was talking about. There are lots of advantages of the general or limited partnership that you're going to want to have a partnership agreement to take advantage of. And so you can't do that without really having a good written partnership agreement. On the limited partnership, it's almost absolutely required to have a limited partnership agreement, because you're going to need to define who is the general, who is the limited partner, and define the roles for those two different entities as well. With a C Corp and an S Corp, you'll have articles of incorporation, and those are documents that are filed with the Secretary of State for the state in which the entity is going to be based. Those basically kind of serve as a discussion of the name of the entity, who the incorporator is, and some very, very basic fundamental issues with respect to the corporation. There's not much in an articles beyond that. Most of that's going to be taken care of by the bylaws. Similarly, with an LLC, you're going to have an operating agreement. And the operating agreement, again, forms something of a basis like a bylaws or regulations for the company. Operating agreements and articles of incorporation can be simple, they can be complex, and a lot of that is driven basically by how complex the restrictions are that you want to place onto the entity. When it comes to management, again, with sole proprietorship, it's only going to be a single individual, so nothing really exciting there. With a general partnership, you'll have likely picked one managing partner, although you can have multiple managing partners. That kind of goes back to discussions that we've had elsewhere in this series about how many captains you want to have on the bridge at one period of time, but you can have at least one managing partner. In the limited partnership, again, the managing partner is going to have to be a general partner. As JC mentioned, limited partners cannot engage too much in the day-to-day operations of the limited partnership, and so the managing partner is going to have to be a general partner. With a C corporation and S corporation, you're likely to have one or more officers who lead the day-to-day operations. That can be a full board of directors. We could talk about having various corporate officers, but there's pretty much a lot of flexibility there. Same thing's true with the LLC. You can have a member-managed LLC in which all of the members have the power of a manager, or you can have a manager-managed LLC in which one manager or certain managers, but not all of the members, are designated as managers. And that's important to remember for the LLC and for any of these entities as well, because when we're talking about who has the authority of the entity, we're talking about the person that can enter into contracts and binding obligations on behalf of the business entity. So who we give that management authority to as an officer really does matter quite a bit. Next comes direction and control. And again, sole proprietor, obviously it's the sole proprietor. When it comes to who has a vote in a general partnership or a limited partnership, all the partners, whether they're general or limited, have a vote in the strategic direction of the entity. With a corporation or S corporation, you have the officers primarily taking day-to-day control of the operations. Shareholders may have votes in the strategic issues, but the officers have the day-to-day control. And then the same thing also holds true with the LLC. You can choose how you want to have that structured as well for the LLC. On the liability side, this may be one of the most important elements of driving someone to pick an entity form as a transition tool, because not only can it provide the transition function, but it can also provide liability protection for the owners. And when we talk about this, we talk about sole proprietorships and general partnerships as having unlimited liability. What that means is that even if a liability, let's say a debt or a lawsuit, is incurred in the course of the business's activities, that liability can consume not only the assets of the business, but it can also consume the assets of those that own the entity. In other words, there's no barrier between the claims of the individual and the claims of the business. They're one and the same. And so you have the potential to lose not only your business assets, but your personal assets as well from a claim that's created from the business. That difference starts to show up in the limited partnership. In a limited partnership, the limited partner has limited liability. And what we mean by that is that the limited partner may lose all of their investment in the business, but that's where it stops. There's a barrier between the business and the individual's assets so that a claim originating from the business cannot consume the assets of the individual. The general partner, on the other hand, has general liability, unlimited liability, meaning that both their business and personal assets are at risk. Now, the C corporation, S corporation, and LLC, all of those business forms have limited liability, which again means that the individual who invests in the business might lose the entirety of their investment, but there's a barrier between them and their personal assets and the business's assets. So a claim against the business cannot consume their personal assets. Now we note on each of these three, the C corporation, S corporation, and LLC, that you must not pierce the veil. And what we mean, that's a legal term. The veil piercing means that you've done something to blur the distinction between the business and the individual. So, for example, you have commingled your personal assets with the business assets. You've used bank accounts for the business as your own bank account. You failed to observe the proper formalities, like filing all of the paperwork required to form the corporation. You haven't had regular meetings. You don't maintain meeting minutes. Basically, anything that you do to make it appear that there's not a distinction between you and the business, the law will regard that as there not being a distinction between you and the business. So if you form an LLC, S Corp, or C Corp, and even with a limited partnership as well, for the limited partner, it's very important to observe the formalities of the business, maintain separateness of the assets, and be very clear that there is a separation between you, the individual, and your ownership interest in the business. And as long as you respect that separateness, the law will respect that also. When it comes to how long the entity can continue, with a sole proprietorship, obviously the business dies with the individual. With a general partnership, from a legal standpoint, anytime you change a partner, you've technically changed the general partnership. And that sounds a little bit weird, but in the eyes of the law, when one partner leaves, the old partnership is destroyed and a new partnership is formed if a new partner joins. From a functional standpoint, though, when we really take that rule into consideration for some tax and legal issues, is when we've had a loss of 50% or more of the partners. That's when we really start to trigger that doctrine. With a limited partnership, the business is going to be deemed to have terminated when we've had the death or withdrawal of a general partner, perhaps not necessarily with a limited partner, though. Now, with S corporations and C corporations, they can have potentially perpetual existence. As long as there's someone carrying on the business of the corporation, it can last indefinitely. With the LLC, your operating agreement can specify how long it can last, and again, an LLC can be specified to last as long as it can, indefinitely. But you might also have an LLC operating agreement that says, you know what, once we've had a loss of X number of partners, then we'll basically shut the business down. But it's really up to you. There's a lot of flexibility there with an LLC. I know we've talked about a lot of really complex issues in today's video recording, and I just want you to remember, as you've probably gathered, this is some pretty complex stuff. Always have the advice of an experienced attorney, and when I say an experienced attorney, I mean an attorney with experience both in agricultural operations and in dealing with corporate law. And then we also want to have a tax professional that's well versed in those two areas as well. You need good professional advice on these areas. With it, you can do great things. Without it, there's a lot of risk of really getting yourself in trouble. And as you go about educating yourself on these issues, just remember there's lots of information available for you at the Farm Transitions website. That's agecon.okstate.edu/farm transitions. One more time, that's agecon.okstate.edu/farm transitions. Thank you for watching.